Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside look at how real entrepreneurs and investors raise capital for their businesses. I'm your host, Nathan Becker, and today's episode is with Winter Mead of Coolwater Capital. Coolwater is an accelerator for emerging VC funds. I recently attended their demo day and saw 28 amazing new VCs present. Very, very cool. In this episode, we go deep into what it takes to raise a fund, understanding the needs of LPs, refining your thesis, pre-marketing your fund, the perception versus reality of becoming a VC, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out foundersuite.com if you're a startup, or fundingstack.com if you are a VC or advisor, to get an awesome collection of tools for raising capital. It includes a massive investor database, a CRM to manage your funnel, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Winter.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite and fundingstack.com. Today I have Winter Mead of Coolwater Capital. How's your day going?
Great, Nathan. Thank you for having me join.
Yes, I'm catching Winter right before he's got 16. Do you say 16 hours or 16 back-to-back calls? Either way, you have a lot of stuff ahead of you.
16 hours. This is a particularly busy day.
Okay. Well, I'll get you while you're fresh. So
lunch will be an achievement.
Yeah. I block off lunch. I actually have it on my calendar. I need a lunch because otherwise my days will get full. Well, let's just jump right into it. What is Coolwater Capital? Let's start with that, and then we're going to get into raising money.
So Coolwater Capital at its core is an accelerator for emerging managers. So if you are an investor and you're thinking through what it means to manage other people's capital and to build an investment firm, Coolwater is the platform to help and support you.
Yeah. And how long have you guys been around?
So I started iterating on the concept in 2016, and this was coming from when I was an institutional limited partner investing into emerging managers and seeing how difficult it was, especially in the early fund vintages. So fund 1, fund 2, fund 3, how difficult it was to build the firm as well as invest the fund. So there's all these different functions. You have to build the ops, you have to raise the capital, you have to invest the capital. There's all these different functions. And so I was starting to see that in 2016. From late 2018 to 2021, I was consulting with a bunch of different investment firms that wanted to set up their funds. And then we've been running the accelerator for approximately the last 3 to 4 years.
And what are some quick stats or metrics? How many funds, how many programs, whatever you choose to report?
So we are moving on to our 10th cohort.
Wow.
We've helped support over 200 funds now. And again, these are not first-time investors, if there are limited partners listening. These are not first-time investors. These are existing investors that are emerging managers. And so collectively, those 200 funds have invested into over 5,000 companies that we're actively tracking.
Give an aggregate and how much those funds have raised?
So in aggregate, I'll do it per cohort. So each cohort, there's roughly, I'd say 500 to a billion of target capacity. So I'm a VC fund. I'm going to market with my fund 2. I'm raising a $50 million target. That would be like 50 of the 500, right? So 10% from one fund. Right. So if you add up those per cohort, there's roughly 500 to $1 billion of capacity. And so in aggregate, over 9 cohorts, you can do the math. But I think, since we've started engaging with those funds, and some of those funds are fund 2 or fund 3, our internal number is, they've raised over 4 billion. But, I guess the public number is more 2 billion. Again, that's not us, right? Like, we're finding great people. We're helping them put a lot of the puzzle pieces together. And it's definitely them doing the hard work. Like, I don't want to take credit for other people's hard work. But yeah, I think there's definitely a signal to the market, like if you're coming into Coolwater. And again, like there's been a lot of successful individuals and fund managers now that have come through the program. And again, like we view ourselves more as an enabler and supporter of great people. And we're trying to track down those investors, all over the US and all over the world.
Yeah, awesome. So before we get into how to raise a fund and how to build a fund, which are, slightly different things, let's talk about who should be thinking about raising a fund. I would guess that a lot of folks are coming to you after doing some angel investing for a while, or what's the kind of typical profile of folks both coming to Coolwater and also raising or becoming an emerging manager?
Yeah, there's a few different buckets. So there's definitely the angel investor. And, when we run the numbers on, who's actually coming to the cohort, I believe the median was about 12 investments. That to me feels a little bit low. Like I think the people that are usually more successful on the fundraising trail have probably 30 plus angel investments, right? Like that's pretty significant. These are check sizes between 10 to, $100,000, right? So again, you can do the math. Like these are not that significant of portfolios, but from a personal perspective, like it can be pretty sizable. Like you've definitely demonstrated to the market, to people that would invest into you, to limited partners, that you're serious about investing, and that if you've done 30 plus investments as an angel, there's definitely some sign of love for investing. So yeah, that's definitely a profile of a manager that comes to us, or aspiring manager that comes to us. A lot of operators. Again, operators have been doing angel investing, but I kind of put them more in the operator bucket. Like they're usually a founder or they're, senior C-suite. And they've helped in a very significant way, right, define the strategy for the company or multiple companies and build this company or these companies. And so I put them more like less in the angel bucket, which is more like you're building your skill set as like this, the go-to-market is more like I'm an investor just doing it with my own money, and now I'm going to become a VC. Like the operator kind of background is more like I'm more of a builder, right? Like an operator, and I'm now raising a fund because of my access and because of my ability to, work with these other great founders. I have a perspective on like how the market works, right? And I think I can put capital to work wisely, and therefore like I'm raising a fund. So that's definitely another profile, like the operator profile. And then there's, I'd say the more traditional spin out, right? Like I've been trained, like VC is an apprenticeship model, some people say. So, it's the more traditional spin out. I'm coming out of a large fund, right? And I have a, specific task there. Usually it's sourcing the next big thing, or I'm coming out of a smaller fund, like a less established fund. And my background is probably more Swiss Army knife-esque, right? Like it's not just like sourcing the next big thing, it's that. And then it's a lot of other like operational things, but you kind of get a love for the game, and therefore, you want to hang your own shingle. And so I think that might be two profiles, but they're definitely like the spin out, like as like the meta bucket. And then, yeah, there's other folks, that when I'm looking for it in terms of criteria of like who comes into Coolwater, like a big criteria, again, this is a big picture, is can this person help support great founders, right? And in this market, right, as it's kind of shifted, especially over the last decade, if the answer is yes to that question, then there's a lot of other pieces that have to fall into place. But if the answer is like, yes, there's high confidence that, this person who wants to raise a fund can be very supportive and helpful to great founders, there might be something there, right? So we start to dig in, and, if those people are great, we try to, convince them to come into our accelerator program.
There's probably not an answer to this, but is there a better profile of those kind of three different profiles? I'm sure there's some blurring and crossover between the three, but is one more fundable than the other? Like is a spin out the most fundable and maybe the operator second, or does it just depend on the individual?
Yeah, I think there's two questions in there. The first is like, what's most fundable? And the second question is like, who should be, right? Like it's the normative, like who should be in market, right? So it's not necessarily the stuff that's getting funded that is necessarily like the most helpful for founders, right? Maybe there's too much of a nuance in there, but yeah, what's most fundable? You're coming out of a brand, you've got the brand cachet, right? Like you've got this aura of the brand. It's more of a marketing game than like a value add game,
Mm.
And so it's more of like putting the pieces in place to have a really good go-to-market for fundraising, right? It's part of like a more focused fundraising strategy, and there's a lot of marketing involved in that. So I'd say that's like what's fundable. If you kind of are self-aware enough, right? Like LPs kind of get this. Like you sell a company for $1 billion, are you going to be able to raise a VC fund if you try? Yes. You come out of like a top 20 firm, right? You've going to have done something like off, right? Not to be able to raise some capital, right? Like how much are you going to raise? Probably depends on like how focused you are, how tight your thesis is, again, like how great your fundraising materials are. So there's going to be some things, again, you have to put into place. You have to do some like pre-work. But when you go to market for the fundraise, like if you're coming out of a top 20, right, like that's going to be funded. It's just a matter of like how much. And like I think the how much really depends on how attributable your track record is at those top 20 firms. So that's what's fundable. I think what I've seen though in terms of what else gets funded, who else is helpful to founders. It's like usually people with founder backgrounds, right? And again, like there's a few answers here. So for early stage, let's say for early stage venture, what's helpful, right? Like what skill set is helpful? And I think if there's like an authentic tie between like what you've done in the past, I co-founded 3 companies, right? I grew them up, I sold them, but really my passion, my love for the game is that early stage part, right? Where I'm helping kind of get these companies off the ground. Then I'm doing the initial product strategy and go to market strategy. And I'm helping the CEO kind of build their initial team, right? Like there's a lot of stuff that you can help out with as an early stage investor. Again, I think if there's an authentic story there, I think LPs kind of look into that and they're like, oh, this is great, right? And especially if it's specialized, right? I'm going to do this for this industry, or I'm going to do this for this technology set. Like then I think those things get funded as well. It's more like I think focus around your thesis and like who you are as an investor.
Yeah.
If you try to be too generalist, if you go to market too early, and you don't have you go to market with 5 angel deals instead of 30, or you go to market and you've only done like 2 deals at a bigger firm, right, instead of 10, right? Like that can make the fundraising journey, I think, a little bit tougher.
Let's kind of segue. My next question is a bit of a segue from that. Like, who should not be thinking about, kind of a 2-part question. Who should not be thinking about raising a fund? Becoming a VC is a sexy title, right? It's a sexy concept. People who've done well as a startup founder or in other places, like, what I want to do, I want to be a VC, right? So who should not be? Or kind of a corollary is, what's the negative part about being a VC? Like, what are things that people maybe don't realize from the outside, that being a VC is really hard, difficult, unpleasant, sort of the reality of being a VC? 2-part question.
Yeah, great questions. So again, I don't think it's my place to tell anyone whether or not they should or should not raise. I think it's more like going back to the last question, which is, are you ready? And again, like, is your story and your fund product going to resonate with the market, right? It's up to you, like how much of an uphill battle you want to face. But I think where it becomes tougher are some of those, pieces that I mentioned, right? Like, it's not like whether or not you should raise. If this is your life's dream to become a fund manager, then you should pursue it. But it is tougher, like I said, if you haven't invested before, right? I've had people come to me, they want to be a fund manager, and they've never made an investment themselves. And for me, like that's a hard logical leap in my mind, right? I've made at this point over 175 investments over the last 14 years. So for me, like, I know I love investing. I know how hard it is, right? But if you haven't made an investment, it feels like, why do you want to be a fund manager then, right? Like you're adding so much more complexity to it. It's like, if you've never made an investment, be an angel investor, right? Like try to find a way to even put like $1,000 to work, right? Or $100 to work, whatever the amount is. Or I've even seen it where you have like, a phantom portfolio, right? Like how much do you love invest? So it feels like some people want to be fund managers and they haven't even invested. And like the core part of being a fund manager is to manage money to invest, right? So that feels like, again, it's not like whether or not you should raise or not, or whether or not you should pursue this dream. It's more like figure out if you like the sport before you play it, right? And you don't have to go and like spend all the money and like sign up for all the camps and, plan out like years in advance. Like just go to one practice, just do like a trial, trial it a little bit.
Good metaphor. I like that. Yeah.
I think like, who should not raise. I think, this is the last piece of advice I'll give for this question, but think about like what you, again, like love doing and what you're really good at, right? So I think this comes down to what's your core competency and your potential competitive advantage if you were to be a fund manager, and, deliberate on that for a while, like figure out, what it is. And if it isn't strong enough, right? Like if you were again, product manager, junior level at a massive company, and you join kind of 7 years into that journey. And again, it's not my place to tell you whether or not you should go out and raise a fund, but like understand like how are you going to win access into the best deals? And that's the most important point. But then there might be another question, which is like, how strong is your perspective to be able to add value, right? And usually those are tied. Like you usually like win access because of the value you're able to provide, or at least the perceived value you're able to provide, right? So I think there's something there too, which is like really be critical about, where you are in your own journey. And if you go to market too soon, like again, like you're going to be facing a steeper hill. The second question you asked is, what's negative about being a fund manager?
Or kind of the reality versus perception, right? Yeah, which is
yeah,
the same thing. Yeah.
Yeah. And I think there's a few things. So, the grass is always greener. So if you think about the kind of the archetypes we talked about earlier, you definitely have a perception of what it's like to be a fund manager, right? Yeah, freedom, set your own schedule, oversubscribe your fund, right? Like you're investing all day long, right? But the reality is, you go from one boss to another boss. You go from, if the archetype is like a spin out, right? Got your boss at the fund, you've got the partners at the fund, you leave, you're successful, you raise your fund. Now you've got 50 LPs and they're all your boss, right? And they're all like asking for stuff. So the reality is like that is usually abstracted away from you, right? If you're at an existing firm, like they've made it easy for you. They've been around for 50, 30, 10 years, right? They've kind of gone through those growing pains of like what it means to build an organization. And the organization has been built and you join as an investor. And, again, like you're searching down, the next big thing. And that's fun, right? Like investors are kind of hunters and like you're hunting for the next awesome deal, right? And a lot of the other management stuff is abstracted away. So again, at Coolwater, we're focused on helping you set up operations, right? That's setting up the business processes. What do you have to do? What's the knowledge set to really understand like what you're setting up? And then like you have to manage all of that, right? So who's going to manage that in the early days when management fees are low? You are.
Yeah.
Right. And so again, when I'll throw some numbers around this, but when I think about, friends who are at tier one firms, what are they doing with most of their time? They are investing, right? And thinking critically about investments, right? That's probably their, call it 80% time. If we'll just break it into like even numbers, the 80-20 rule. But if you think about the fund manager, right, what is their 80? I would argue it's not investing anymore. It's managing, right? It's managing all the other things to actually like run the fund. And so again, I think, is there a point here? I think the point is if you want to become a fund manager, like you have to have a love for the fund, the investing part, but also love for the manager, like the management part too, right? Because you're going to be doing both as a fund manager. You're not just going to be doing the investing part. That's just one of the several functions you'll have to manage and operate on a day-to-day.
Yeah, no, that's interesting. I mean, and that's probably there's probably a lot of nitty-gritty in there that we can unpack a bit in setting up operations. But I'll lead you a little bit on this question. I mean, I think the perception is like you're saying, you become a VC, you're investing all day, and I think there's maybe a perception also that you hang out the shingle and startups just kind of come to you, and I'm sure in many ways they do, but getting access to the best deals is actually very hard. I guess where I'm leading you with this question is, isn't being a VC actually much harder than it looks? Because you've got to hustle like crazy to get into the best deals. I guess what's some of the misperceptions about the actual investing? Yeah.
Yeah, I would ask the VCs, but the answer there is absolutely yes. And again, just because you have money doesn't mean founders go to you, right? If capital is fungible, or all capital is green, at least in the US, like what does that mean? You raise, right? Like take the example, you're successful, you raise 50 million bucks. What does that mean? It means you've raised 50 million bucks. It doesn't mean you have a great strategy. It probably does, because like who else would give you 50 million bucks? Like maybe you have like really great capital networks. But now you've raised 50, you have to execute on your strategy. What's your strategy? Your strategy is to build a portfolio that returns multiples on itself. How do you do that? You have to find exceptional deals, right? If you have a portfolio that's that big. And what is 50? Is 50 a seed fund? Is it a Series A fund, right? Who's your competitive set? Like, are you competing against the best investors in the world that are also dipping down to post seed and A, right? So you're trying to win allocation. And again, like what's your portfolio construction? What check sizes are you writing into these deals? And can you write that size of a check into the deals, right? So you better know that already. Like you better have those answers in place, right? Or, and maybe everyone isn't asking you that question every day. But the question is like, if you have to deploy $2 million into a Series A deal, can you do that? Will the founder take that $2 million from you? Because that's, if they take, there's opportunity cost for the founder. If they take your money, right, and they're only raising so much, right, because they're thinking about dilution or something else, right? They're not taking 2 million from some other person that could be more connected or more valuable or is better at executing on the strategy, right? So thinking about, those two things in tandem is pretty important, right? Like it's not only raising the money, that is like a huge kind of lift in the beginning. That's, what our core program is for, the build program. It's like helping you think through everything in order to, launch your fund initially, like raise your fund. But then like you've raised it, the game's just started, right? Now you actually have to play the game and kind of, win the game time and time again in order to build a great portfolio.
Yeah. Cool. Let's get into what it takes to raise a fund. So kind of going back to your profiles, maybe you have 30, 50 more angel investments. Maybe you were a notable operator. You helped build some startup from 7 people to 700 or whatever the numbers, or maybe you came out of a more established fund. Given that as a sort of baseline foundation, what else does it take to be marketable and attractive to LPs? Give us some of the ingredients that go into the stew here that you guys kind of help mix together at Coolwater. Does that make sense?
Yeah. So my first book was How to Raise a Venture Capital Fund. So it's pretty straightforward.
Amazon? Where can we find that?
Yeah, you can find it on
right now. Why not?
Yeah, find it on Amazon. It's in a bunch of other places as well. But that's the easiest place. And it's pretty straightforward what that book is about. But it comes from the limited partners perspective, right? Which I think is helpful because it's like you're understanding the other side of the table. So if you think about venture deals, right? Brad Feld's Venture Deals, which is also a very popular book. And I think it set the stage to help a lot of founders, right? How to raise a venture capital fund. Like I wrote that in order to help a lot of GPs. Because like if you understand the other perspective of the VC as a founder, that's a helpful book. If you understand the other perspective as a GP of like what the LP is thinking, right? That was my intention behind writing that book. But I kind of in that book, I break the fundraising process into a few stages. So again, like if you just mentioned those archetypes, angel investor become fund manager, operator, builder, become fund manager, spin out of a great fund, to hang your own shingle, become fund manager, right? Like, what do you need to do? From what I see is, I'd say the best fund managers actually do a lot of premeditation, right? Like the most extreme example is, I know who this is. Like I had, I call him a friend. He came to me literally 5 years before he was going to spin out of his tier 1 firm. And for me, I was like, that might be a little too much meditation, right? Like you're in Shavasana a little too long at that point, right? You need to wake up from the nap. But I think the idea is there, the concept is there of you're thinking about, right? Like these things that you have to achieve. It's not just like you wake up, on bed, like the left side of the bed in the morning and be like, I'm going to be fund manager today, right?
Well, people that are successful here that says, what advice do you have for people that want to be a VC in 5 years from now? So this is perfect. Keep going. Sorry. Keep going. Yeah.
Yeah. So the idea there is like you are thinking about those stages, and in the book, How to Raise, there's a stage called pre-marketing, right? It's like before you go to market to start talking to all the people and like pitching your product and doing the big kind of marketing and sales effort. There's this effort of figuring out all, like pulling all the pieces together, right? And I think you start doing that. Like if you want to be a fund manager, you start doing that earlier rather than later. Maybe this is like the behavior of a great investor, right? You're just prepared. Like, oh, I'm going to make this investment. Instead of just flying by the seat of your pants, like you put together an investment memo, like you make some reference calls, you do the diligence, right? Like you put together the financial model, you think about like, do these things add up? So I think it feels like, again, people that are successful are starting to do that early. And what does that mean specifically? It means putting together a track record. You should already have been making investments, but it's like putting together that track record. It's, putting together a bunch of other documents, which we won't necessarily go into on this pod, but like, we go into in depth in the accelerator, but it's like putting together those kind of the initial story and the initial narrative of like, what makes me great and why does the market need this product, right? It's the same thing. Like if you're gonna, go into the soda market, right, and create like the next generation soda, that's probably going to be sustainable and good for you, right? But it's like, what actually makes it so special? What makes you so special to deliver this go to market? What is the actual product? What's going to resonate with customers? Like it's that part that I think is sometimes missing. That's important, and putting that together. And so there's probably the conceptual phase of that, and then there's the actual like practical building phase of that. And I would kind of lump all of that into kind of pre-marketing, where yeah, if you can't get to like a really strong, I'm the perfect person for this strategy, my product really resonates with the market at this point in time, and I'm ready to kind of do this, mentally, philosophically, et cetera, then yeah, again, like I think you're going to have, again, a more challenging time raising your fund.
Okay.
I don't know if that fully answered the question.
It does. So let's say we've got a track record, we've got our story, you've got a thesis, right? I mean, maybe we segue into kind of what is a good story or thesis. Let's actually make that a question. What does a good story or thesis look like in today's market?
Yeah, in today's market, I think a story is kind of bigger. Like if we're trying to define these terms, like sure, the narrative or the story, that's kind of your overarching, reason for being, right? It's like everything comes together and you have this great story. You went to undergrad and you did pre-med, you went to medical school and you did a PhD at the same time in, something biotechnology related. You went and you worked at 2 different biotechnology firms. You decided to start a company because you wanted some operating experience. You did that for 5 years. You didn't hit it big, but, someone, poached you and kind of scooped up the company, right? So you have an exit under your belt. And you've been doing angel investing on the side. And now you're ready to kind of like put all that together in like the narrative and the thesis. The thesis is kind of like what comes together in terms of like your understanding of where the market opportunity is now, right? So the thesis can differ depending on, again, like, yeah, what is the market opportunity now? It might be different in 2021, right? So your strategic positioning in 2021 might just be like, I need to put my fund formation docs together and extend my hand, and you're going to raise a fund. But in today's market, like you might have to say like, oh wait, now I have to do that pre-marketing phase of the fundraising process. I have to pull all of those different experiences that I've had, and I have to think about what am I going to invest into? Like, what's my authentic investment strategy? And then you have to figure out, right, like, how does that flow into a fund? And how is that going to be repeatable? Because you're going to have to put, maybe 20 or 30 or 50 assets into the fund, right? So how do you do this over and over and over again, right? And does that, big picture, fast forward 5 or 10 years, lead to multiples of that fund, right? Like, again, you raise 50, you're going to have to generate, 4x in order to hit your target returns or hit the LP's target returns, right? So you're going to have to generate, an additional $150 million of value. Like, are you going to be able to do that? Your thesis should inform what you're betting on, what you think the opportunity is. where you think the value is in the market that you're able to capture. Like that's kind of the key piece, I think, when you're thinking about thesis. But I'd view them as different. Like the narrative is kind of the big overarching, everything comes together, and like you define kind of your fund product and your go to market, and the thesis is again, your unique insight on the market that you're able to articulate that makes you the best for what you are, right? It makes you the most authentic for your fund product.
How important is it to have a truly unique thesis? Or if you've had, like the example you gave, you got your medical degree, worked at biotech companies, started a company, been doing angel investing in biotech, and now you're raising a biotech fund? Or does it have to be biotech for, AI for biotech that solves pancreatic cancer? Like, does it have to be a granular thesis? How important is unique thesis these days?
Unique, there's a balance. I feel like I used to be kicked out of investment committee by a prior boss who didn't like the word unique. But everyone is their own special butterfly. The idea behind like a fund, though, right, is an AI fund, right? And I think there's what you're trying to do probably is what I see emerging managers do is sometimes they may try to appeal to everyone, right? Like I gotta be friends with everyone. But I think good investors they have a thesis and they kind of like stick to their line on that thesis. So like, this is how I'm going to capture value. And it's like, some people agree with you and some people won't, right? It's almost like if we jump over to the hedge fund industry and you think about the concept of like zero sum investing, right? Someone wins, someone loses, right? It's like someone's taking the, like the counterparty part of that trade, right? But in the venture world, when you're fundraising, like you can kind of take that as a corollary and kind of say like, you have a thesis. This is how you think the world works with respect to, maybe where AI meets biotech. And some people are probably going to agree with you and some people aren't going to agree with you. And so, if you try to appeal to everyone, then you're going to appeal to no one. But I think if you go to market with like, this is what I believe, this is how I think the world works. This is how, this is my experience. This is why I think I'm the best and the most special and unique. And this is how I think, based on my uniqueness, I'm going to capture value through my investments over and over and over and over again, right? If it's a believable story, then I think that's a strong story. Like, is it unique though? Like, are there other people that, got the PhD, MD and kind of worked in biotech and, also had an exit? Like, yes. Like if you're working in a certain echelon, like there are going to be other superstars there that are also raising funds. So it's not necessarily unique. Are LPs going to invest into more than one fund in that strategy?
Yeah.
Maybe. Like if they're looking for that and they're like, hey, I want to put, 2 to 5 bets to work in this strategy, then maybe they do you and a couple of other kind of funds that, offer diversification. So they're not all investing into the same one deal, but maybe they have the same thesis. And maybe it's like one's for the West Coast and one's for the East Coast, or one's for North America and one's for South America, or one's for, if it's biotechnology, one's for North America and one's for, Europe or something, right? So you have 2 funds. The thesis isn't unique necessarily. Like it's the same kind of belief on like how you're going to capture value, but the LP bets on both because of some difference, right? It's like geographic difference in this case. So again, just things to think about. Like you don't have to be unique. I think some emerging managers may think that, and then they get too granular, like that example you just gave. That might be too granular, right? But a fund that's doing, focusing on oncology generally, right? They could do biotech. They could do pancreatic cancer. They could do AI as it applies to like that, realm. Right. So it like you've said it now in a more general term, like it's still specialized. People know what you're investing into, but it's specialized enough so people know what you're focusing on. It's general enough so that like you can have diversification in your portfolio. And I think if you over define kind of your strategy and like what you're investing into, and even your thesis, then it's just too specialized and you're not gonna like have the flexibility to optimize your investment bets. You're gonna have to like invest into stuff that's suboptimal because you're too specialized, and that's what you sold to your LPs, and that's their expectation. Like the people that bought that are expecting you're buying all these super specialized bets. And again, maybe you found like the niche of the market that's the most valuable, right? And then like, it becomes like a wild success story. But most of the time I see it like as it's too narrow for you to be able to have flexibility to find teams that are great, that are going to build like really big things. and you kind of struggle, and therefore you have to have scope creep, and that's when LPs start passing on your next fund.
Let's move on to another topic, probably a big one that people come to your program for: how to find investors and how to build relationships with investors, and ultimately how to get investors to write you a check. Now, that's not really a question, but how do you kind of coach folks in your program through that part of the process?
Yeah, so we've talked a lot about what to do, what not to do, how to think about defining a strategy, how to think about putting together the right materials, how to think about defining a thesis, right, and making sure it's not too specialized and not too broad, but something that, again, resonates with the current market. So all of that's good. I think that's really important, right? Like, you're building the foundation for being able to now find great investors, right? But if you find them too soon and you don't have any of that kind of pre-work that's gone on, then it might be finding investors prematurely, right? If you're following.
Yep.
So I think, there's a certain, I'd say, timing to finding investors. So make sure like other things are put into place. Again, that's, why the Coolwater Accelerator is there. There's this knowledge I believe every emerging manager should have, right? This knowledge set. And there's kind of a development of your fund product that every emerging manager should have before they do their go-to-market. And again, like, we do work with fund 2s and 3s, but I'd say, half to more than half of folks are fund 1s that kind of engage with that core accelerator program. So once you have the materials in place, once you've kind of set the foundation, once you believe you have, a strong fund product, then you have to go out and find investors. I mean, you're more of an expert on it than I am, or many emerging managers, right? But you have to do a few things. One, determine which CRM you're going to use, right? Because this is going to quickly get unwieldy, right? So that's probably like your
funding stack, perhaps. Yes,
essentially like funding stack. But you're going to have to determine like which CRM you're going to use, and then why is that? Because for as great as you are, this will still be a bit of a numbers game, right? And again, like, we've talked about these percentages in the past, Nathan, but 10% is great, right? It's going to be lower than that.
Conversion rate is what
10% conversion rate of, you talk to 100 people and 10 invest in your fund, like, that's amazing, right? So imagine if, you want to try to get to 100 LPs, you need to talk to 1,000 names.
Yeah.
So how do you keep track of all of them? How do you keep track of all the follow-ups, right? So that's kind of, again, like, you've defined your fund product and all of that, but now you're kind of like starting to define the operation stack for your firm, and having the ability to be well organized, to learn from the process over time, right? So talking to all these people, what's working, what's not working. Most likely what's going to work for an emerging manager is, starting with people that believe in you. Usually people say like friends and family, right? But I would say it's more like, I'd say the bucket is those who believe in you more so than friends and family, right? Because like, maybe family is in a different industry, friends, like, they're great. And like, do you have they done business with you before? Do they know your competency? It's like, it's almost like it's the belief bucket initially, where people bet on you, especially for an emerging manager. If you're, this is true, you're raising 10 or 20, like, you're going to have to run a lot of cycles within a trusted network. And it's a positive signal. If you're thinking about, again, like, going back in the conversation, should you go out and raise, right? Like, who should not raise? If you go to people that you think believe in you and none of them want to write a check, again, maybe it's time to like rethink the strategy. And, again, like, ask them for their feedback, right? So I do think there's that, finding them, you've already found them. Congratulations, right? It's not like you're going to go out and like magically find, a garden party in, Woodside, and everyone there is going to be wanting to like throw money at you. There's probably a few people in the world where that's the case. If you're that person, go to that Woodside garden party, and let me know about it and I'll join you. Yeah. But I think the idea here is like, or the concept should be even simpler than that. It's, if you are great, right? You've already done the work, right? People can't, like, your competitive advantage is you've been awesome for 15 years and doing good work for 15 years. Go to the people that believe in you and like tell them what you're up to and see like if they want to support that next thing. And I think that's the first kind of like finding like your initial believers. That becomes part of the narrative. You've had a lot of people, they believe in you. Like what? So it's like, you know what? I'm thinking about it. I'm going to put together a fund. I'm a really good product person. I had this really lucky experience. I've built this like amazing product that millions of people use, and like, it's head of that team. And I feel like that's my special kind of core competency, is helping build these like next generation products. Maybe my LP base should be other awesome product managers and product people, right? So it's like, who believes in you, but you're also thinking about it with respect to maybe the bigger picture of like, you can just go to people and be like, hey, I'm awesome. I'm awesome. Like, can you write a check? And then like, look at me, I've got a fund. But you could also be more strategic about the fundraising process, right? So again, big picture point is you've already found people that want to invest in you initially. If they're not investing into you, go and rethink the product. If they are investing into you, think about it like one layer more strategically, maybe, and just say like, do I have a theme here, right? I'm doing biotech, right? To our other example person in this conversation, like, is it like, should I have other healthcare people invest into me, right? And that might be another telltale sign of like, who believes in your expertise. Is it like, if no one in your biotech arena, your doctor circle, like, is like investing into you, then maybe it's like, oh wait, like, do they believe that I'm not going to be able to find great investments in this theme of like AI meets biotechnology? Maybe the answer is no, right? So then again, go back to the drawing board and figure out like, why is that? But if everyone who is not in that realm, like, is investing to you and they're not in healthcare, again, the reason might be because they want diversification and they're like super concentrated in consumer or some other field, right? Or some other industry. And so they totally believe in you and like, you're going to knock it out of the park. But again, like, there's 2 points I'm kind of making. One is like, how do you find like people, and then like bring them authentically into the story, into the narrative? Who do you want to work with? Like, you're probably going to have to engage with these people a lot, right? Like I said earlier, like they become kind of your bosses in a way. And so, engaging with them and making sure like they're going to add value to your firm that you're building. Like, some investors just want to invest and maybe you're fine with that, right? So they write a check, you never, you just report to them. But some want to be involved and some will ask questions, and maybe you want some to be involved because they're so expertise, right? So again, the finding and the building, and kind of being able to like set up your LP base to strategically try to drive more success for your firm is an important, I think, point to think about when you're just getting started.
I like that. I mean, yeah, I like that. Like, sticking with that example, you're doing a biotech, oncology, AI for oncology fund. Hopefully that's broad enough. Going out and getting a bunch of LPs that come from that space. That could be great for deal flow, could be great for credibility. There's a lot of advantage. Okay, since we only have roughly 10 minutes left, I've got like 5 or 6 quick answer questions. So, do your best to just answer. These are bigger questions, but answer them as quickly as you can. Short answers. So, solo GP or don't bother?
For the LP perspective,
Let me rephrase that. You want to raise a fund. Should you go find a partner, or, is it doable to be a solo GP?
I would say solo GP if you don't have an existing investing track record with someone else. So usually if you're a solo GP, you have a short list of people that you sat on the board with, that you've invested with as an angel, right? That you're thinking about being a partner for a number of years. So if you don't have that person, that like shortlist person, then for the fund, right, like who's going to be the key person, I'd say do it as a solo GP. Don't try to, get married too soon on the investing side with a partner that does not have an investing track record that you share deals already. So the point there is like, you want to have a working history on the investing side, or an investing history with this person. You know how they invest, you know how they think, you collaborate together. So like, that's a really important piece.
Do a lot of LPs, and we'll move on in 30 seconds, but do a lot of LPs pass on solo GPs? Like, is there kind of like how VCs often will not invest in solo founders? Is there a bit of a stigma in being a solo?
It used to be bigger. Like, there used to be like, even the most famous VC fund of funds now used to pass on solo GPs, like by mandate, and they've become more flexible because like the market has changed. And so they've had to change their mandate. But I would say in today's market, you can do a solo GP. I would still think for institutionals, like they still want a team. So if you are a solo GP, the advice would be, if you do the proverbial get hit by a bus, like what happens, right? Think through that. Make sure you have a plan in place for that.
On average, from folks going through your cohort, from your previous work as an LP, how long does it take to raise a first time fund?
Yeah, again, this is going to be market dependent, but between 6 and like the best of markets to 24 months, which is usually like the end of when you can actually raise if you're really pushing the limits. I think most people are giving themselves 2 years of budget to do the first raise.
Yeah. Okay. Fair enough. And these are great frameworks, right? I'm thinking about raising a fund. I need to kind of plan for being out there hustling for up to 2 years. Now, harder question, but how much to raise? Do you guys coach the folks coming into your program of what a good first time fund is? Something that's enough money to really get going, but achievable that you're not out there for 36 months trying to raise it.
Yep. Yeah. So a couple ways to think about this. One, what's your strategy and like what are the fees you need to sustain that strategy? So that could be a minimum fund size. Another framework would be just, what's achievable? And then another framework could be like, what can you actually execute on? Right. So even if you could raise a $200 million fund, do you want to compete at Series A? Right. Like maybe you're amazing and can get like, premier majority, stakes for seed investments. Right. And like you have the relationships and the access and the discretion to do that. So maybe you do 50 or 75 and you do seed instead of 200 and do A. Right. Again, it's really certain. You have to think about it in terms of like a framework. I think like, what are you trying to achieve and like what makes the most sense for you and your team?
Have you seen an average of the companies that go through your program? On average, the average amount they're raising is 50, 20. I mean, what is there?
For our ecosystem, the median is about 20.
Okay.
So we're focused on, we have worked with larger funds, up to 150 in terms of targets. And again, my prior track record and experience is investing into funds up to 15 billion. But for Coolwater, we focus on the sub $100 million category, which is usually emerging managers focused on technology earlier stage.
Okay. But if you're raising from mostly individuals, high net worth people, and maybe a $20 million fund, there's a limit in how many LPs you can have. Am I correct? When and what is that limit?
The limit is right now 100, including yourself. So you can have 99 LPs, assuming you're taking accredited investors, qualified clients, and QPs, like as a blend. I think if you just accept qualified purchasers, which just view that for the audience as you're a wealthier individual, you fall into a different qualification by the SEC. You can take up to, I believe it's 2,500. So it's a significant number. So like some of these bigger mega funds, right? Like they're really just going to be asking for commitments from qualified purchasers. But for smaller funds, again, the friends and family, the people who believe in you, the folks writing, scraping together 10, 25, 100K checks, right? Like if you're only taking 100K checks and you have 100 investors cap, right? Like you're only going to get to 10 million.
Yeah.
Right. So you can't get to 100 million by, even if like you had all these believers, you had a great brand online, right? Like you just, from a regulatory perspective, can't take that many more. There are some, I won't go into it on this call, but there are some changes happening, or there's some proposals of increasing that number. I believe it's from 100 to 600. So that would give more optionality for emerging managers to take more smaller checks and get to a larger fund size, which would make, again, if you're thinking about it from that first framework of how much do I raise, would make the sustainability of being an emerging manager more, maybe more, just easier, more relevant, actually doable for you. If you raise a $5 million fund, it's very hard to just do that, right? If you raise a $10 million fund, it's very hard to just do that based on management fees alone.
Yeah.
Right. So if you see an attrition rate going on in the market over the next couple of years, that's a big reason behind it, which is just like, you can have great investors. Like, it's not like they're bad investors necessarily. It's just like, it doesn't make sense after you run the budget and pay all the expenses. You're not making any money. Like, you've basically built a great portfolio for your LPs, and you've done it more as like a charity than anything else. Like, it might pay out in 10 or 15 years, right? But, it's a version of what I call philanthropic capital. It's the parts of VC that like don't pay off very well in the near term, right? Other than like, but again, like in the long term, maybe it actually turns into like philanthropic dollars. So something to think about it.
Okay, a couple more. I'll let you go, but and just a short list here of your core materials. What do you need to create? Pitch deck, PPM. I mean, like, what's sort of that minimal viable set of materials to go raise?
Yep. So I would say start with the pitch deck and just iterate on that, right? If this is kind of advice for people that are thinking about becoming fund managers, don't think about anything else until people are willing to kind of like engage with you and even kind of buy your fund product with pitch deck. Everything else is a waste of an expense.
Okay, fair enough. Minimal set of back office tools or things in place. What do you kind of need to get in place? Just list, short list.
Yeah, you kind of need like a big, say email, obviously. Like maybe you want to set it up more on like the business side versus the personal side to start. CRM, easy, credit card, bank account. And then, maybe you have some stuff, like I said, the marketing materials, especially pitch deck. So what are you creating with that? So again, you're not going to have more than 10 expenses. It's probably closer to like 5 to start, but run it super lean. Like see if this is a thing, right? Have your go-to-market like very efficient. Like you can do this very, very efficiently and very cheaply. But like once you kind of build that confidence that this could be a real thing, again, like you're going to jump a few stages over time.
What are people using? And I guess name brands if you don't mind, but like what are people using to manage and report their portfolio to LPs? Is there sort of is it Carta? Is it something else? What are people kind of doing that with?
There's no winner in that market yet.
Okay.
If you're reporting to LPs, if it's a winner, it's like a newsletter, software.
Okay.
So, and so you write kind of a report, newsletter, usually happens every month. Like if you're more aggressive and on top of it, or quarterly. And then if you've started investing, you're kind of post first close and you've made some investments, then you start, sharing your financials as well. If you're a smaller fund, you're not necessarily doing audited, so it's just financials. And then like you have this kind of report where you share a lot of like rich, helpful data that LPs can really understand. Yeah, like where you are in the journey, what's your strategy, how's the organization growing, what are you investing into? They primarily care about how the strategy is playing out. Like you told them you're going to do this, are you doing that? And kind of what's in the portfolio. But yeah, it's mainly just like an email. Like people keep it, again, really simple in the beginning because they don't have excessive budgets.
Okay. Last question. Any other tips that we haven't covered that you tend to, common advice you give to people contemplating the emerging manager path? Is there anything we haven't covered? Your favorite piece of advice you like to dole out?
I think we've been pretty comprehensive. I think hopefully people should walk away like knowing or having more confidence in terms of, I can test this out and see if it's for me. Right. And understanding kind of that premeditation phase, like, okay, what should I be doing before I actually do it? One thing I will say is, I wrote a second book, how to set up a venture capital fund. So the first one is how to raise a venture capital fund. The second one is how to set up a venture capital fund, but starting to think about your back office as an advantage. So, we have a program after the accelerator called Strategic CFO. So you're successful, let's say you're successful, you raise $25 million, you're off to the races, you start putting, investments into that portfolio. Now you actually have to build out great business processes, a great back office, and manage that back office. So Coolwater actually does that. We build the back office for you and we manage it. So thinking about that, again, like one step at a time, but something to think about. Again, it's like foundational work, right? Like you can't build a skyscraper without having a good foundation. So one step at a time, start with the foundational work and kind of what you need to do to even see if like becoming an emerging manager is a possibility. But once it becomes reality, there are going to be other parts of this journey. So again, always thinking ahead a little bit and knowing that it's going to continue to be a management exercise, but hopefully a fun one and hopefully one that's, lucrative for you and your LPs over time.
I'll let you go. I promise. Just let you plug Coolwater for a sec. Is the back office sold on its own as a service, or is it only for people who go through your program? And the second part, if people want to apply for the program, how do they do it?
Yep. So if you want to apply to the program, please just reach out on LinkedIn, right? Or shoot me an email, winter@coolwatercap.com. The CFO program, right? Like think of that as a parallel program. So we've got the core accelerator that's really focused on helping you launch your fund. But yeah, if you're you've already launched your fund and you're thinking about setting up that back office, like we can help you think through that, right? As a separate program, and that is sold as a service. So you can engage with us on that. But I think let's start small and figure out like what are you even doing here with your back office? Let us help you with that first before it turns into a larger engagement.
Very, very last question. I promise. No, we're over time. How many cohorts per year, and what's the cycle? And then what can you share what the acceptance rate is? I'm sure it's very competitive, but
yeah, the acceptance rate is always sub 10, usually sub 5. So give you a sense, I talked to 1,010 managers last year that were qualified. Top funnel's bigger than that, but these were qualified. We ended up working with about 60 managers. The pacing right now is about 2 core cohorts a year. So yeah, I'd recommend if it sounds intriguing, right? If you, again, want to learn all the ropes, have the knowledge set, get a really strong foundation, and kind of be engaged in a community of people that have been successful and are continuing to build their firms, most likely over the next few decades, then yeah, Coolwater could be an option for you.
Very cool. Very cool. Thanks for all the insight. Coolwatercap.com, I believe, is the website. Is the application on there too, or should people email you for the application?
Just email me for the application at this point.
Okay. Gotcha. All right, Winter, thank you very much. This is really insightful. I could go on and on with 1,000 other questions, but we'll pause it there. Appreciate your time, and best of luck. And I'll see you at your event. You've got a demo day coming up, which is pretty cool. So
thanks, Nathan. See you next week.
over now. Thank you.